Another option would be to post the gold as collateral to outsiders and then have them lend to the U.S. government. And so there we keep the gold, but we also get the funds. So the upside is you get to keep the gold. So that's what's different from the first scenario where they just sell it. The another upside is you capture that capital gain, right? When we post it as collateral and borrow against it, the lending entity assessing the collateral can recognize that, oh yeah, if we seize that, in the event of a default on this loan, we could sell that, they would value it at the market price. So that's a benefit. And then the question is, would that increase the national debt? It would in gross terms, but not in net terms.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm going solo again, and this time I just want to lay out the possibilities for revaluing the gold held by the federal government, because I've seen some people think they can have their cake and eat it too, and I don't think it's right. So I'm not against the proposals that I've seen, but I do want people to go in with eyes open. So specifically, I think there are a lot of people who are interested in this concept and they have plans in mind for what the U.S. government should do with the money. Some people want to use it to help kickstart a strategic Bitcoin reserve. Other people just want to use it to retire the debt and so forth. Various things you could do with this money. And the idea is that I've seen is some people seem to believe that the government could simply revalue the gold on its books, which right now is being carried at roughly $42 an ounce. Obviously, that's not the correct market price. And to say, oh, we're just going to revalue it, enjoy the capital gain, somehow pledge that at the Fed or have the Fed acknowledge that, pass it through to the Treasury, and then they can go spend the money. And the national debt didn't go up. We didn't borrow it. And it's not inflationary because there's real assets backing that up. And hence, boom, we just get $850 billion without having to suffer any downside. And stated in those terms, that's not quite right. That you don't get all of those coming together in the same package, right? So there's various ways of getting all but one of those items. And that's what I'm going to walk through in this episode. Okay, but before diving into the details, let me just give the context here and what's making me decide that I should do another episode on this, because I think I've touched on this before. But let me go ahead and explain. On August 1st, 2025, there was a Federal Reserve note that was put out titled Official Reserve Revaluations, The International Experience by Colin Weiss. I'll just read the first paragraph here. With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the U.S. and Belgium recently. For the U.S., this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. All right, let me just read one more paragraph just so you understand what they were doing in this particular note. This note reviews the rare cases when countries used proceeds from valuation gains on gold and foreign exchange reserves. Over the past 30 years, only 5 countries have done so: Germany, Italy, Lebanon, Curacao and St. Martin, and South Africa. And Curacao and St. Martin are one entity. What motivated the governments in these countries to use the proceeds from valuation changes in their official reserves? How were the revaluations implemented, and what were the outcomes? Revaluation proceeds have been either used by the central bank, as in the cases of Italy and Curacao and St. Martin, or by the central government, as in South Africa, Lebanon, and Germany. All right, and then they just go through. Okay, so this note did not go on to say anything specific about the United States. It was just saying, hey, this is in the news now. Some people have actually proposed it for the U.S. So here's what we can say about how it was done historically in these 5 cases over the last 30 years. And they just went through the mechanics of it in terms of the accounting on the central bank's balance sheet and that sort of thing, depending on if it was the central bank that sort of recognized the gain or they passed it through to the central government, that sort of thing. All right. So for our purposes here, let me just mention using their numbers. So 261.5 million troy ounces of gold that right now is being carried on the books at $42.22 per ounce. If you recognize that, well, if you marked it to market, in other words, it's $3,300 per troy ounce, assuming I did the math right, that's about an $850 billion gain just by, again, not doing anything except recognizing that, the gold that the U.S. government at least claims to hold actually has a market value that's about $850 billion higher than what it's carrying on its books at the moment. And so a lot of people have thought, can we do something with that? All right, so let's just go through the possibilities. I guess before diving into that, let me just give a little more background on why does the government own so much gold and why is it carrying it at that odd price of $42.22. All right, so the brief history, if you want to get a full history, I suggest you check out my book, Understanding Money Mechanics. I'll put a note in the show notes page here. I'm putting a note to myself to give you guys a link. It's a free PDF. You Google my name, Understanding Money Mechanics PDF, you'll get it for free. But I have my chapter 2 in that gives a quick history lesson on the U.S. and the gold, and also there was a silver standard originally, okay? And so originally the U.S. dollar was defined in terms of gold and silver, and then, in 1873, silver was demonetized completely. It had been winding down. And so from that point forward, the U.S. dollar was defined in terms of gold, and that was true up through World War I. The U.S. was, in the eve of World War I, it was on what's called a classical gold standard, right? Most nations in the world, certainly all the major ones, had defined their currencies, their national sovereign currencies, the French franc, the German mark, Italian lira, U.S. dollar, British pound. They were all defined in terms of specific weights of gold. And so that implied an anchor exchange rate between all of them. So it wasn't that there was a law saying you have to trade $4.86 in terms of U.S. currency for one British pound. It was just when you looked at the respective definitions of the pound and the dollar in terms of grains of gold, that was the implied arithmetic outcome. And what that meant was if the market exchange rate, the Forex rate in reality, in terms of people literally trading dollars against pounds, if that rate deviated too much one way or the other, it would open up an arbitrage opportunity. And people would short, they would present the overvalued currency to the issuing government, get the gold, ship it across the ocean, and then get the other currency. Okay. And then trade that back for the original currency. They'd end up with more of their original domestic currency. So there was like an arbitrage you could do to take a given amount of your own domestic currency and turn it into more units of that. And what that would end up doing is drain gold from the inflating country out of their vaults and ship it across the ocean into the vaults of the countries that were more conservative. All right, so those were the natural checks and balances on all the national governments issuing sovereign currencies when the world was on the classical gold standard. And at that point, the definition of the dollar in terms of grains of gold worked out to about $20.67 per ounce. They didn't literally define it that way. That's just if you did the arithmetic, that's what it would work out to be. Okay. That held true until 1933, right? So there were the depths of the Great Depression. FDR wins in the 32 election. He's sworn in March of 33, because back then new presidents got signed in and sworn in March, not in January like it is now. And then one of the first things he does, FDR coming in the depths of the Depression, is force Americans to turn in their gold. And it wasn't just a friendly suggestion. It was like you get like a 10-year prison sentence if you didn't do it. All right. And then, oh, don't worry. They gave you paper money, right? You got US dollars in exchange for it. They didn't just rob you. For every ounce of gold you gave them, they would give you $20.67. And then you know what they did? Like a year later, they revalued the gold to $35 an ounce. Okay. So that's a neat trick from the government's point of view. They got all this gold that they got through threatening to throw people in prison. So they were able to, in a sense, buy everybody's gold at the prevailing price of $20.67. And so now the authorities own all the gold. And then they decide, oh, the Federal Reserve now, you're allowed to print more dollars, both literally physically print it, but also electronic, well, not electronic, in terms of bookkeeping operations back then, to issue more reserves, right, to inflate the quantity of US dollars in existence in order to raise the dollar price of gold to $35 an ounce. Right? So the government made a hefty profit on that. They bought a bunch of gold effectively at $20.67 an ounce and then revalued the gold to $35 an ounce like a year later. And say what you, I'm obviously my take is very cynical, as you can tell from my tone. There are plenty of economic historians, for what it's worth, who would say, oh, that's what they needed to do. They needed to inflate to get the U.S., it hit rock bottom and to get them to grow out of that slump and have an expanding economy. I disagree with that, but okay, that would be what somebody would tell you in terms of the official story as to why they did that. Okay. That new price of $35 an ounce prevailed through the Bretton Woods era. So nearing the end of World War II, when it was clear the Allies were going to win, the major powers all met in Bretton Woods in a posh resort or hotel in the United States, and they hammered out the post-war monetary arrangement. My understanding is originally the British pound and the US dollar were going to both be global reserve currencies, and then soon thereafter it became clear that Great Britain's really not. It's just a pale shadow of its former self, and it's basically a dollar reserve system. So after World War II, the way the international system worked, rather than each country maintaining stockpiles of gold that sort of backed up their respective national currencies, and anybody could present those national currencies for redemption in terms of gold. That's kind of what kept everybody honest, right? So I should have been clear about that. In that earlier example I went through, when I said before World War I, like if the U.S. authorities printed too many dollars, then people would just present them to U.S. authorities, get $20.67, get an ounce of gold for every $20.67, ship it across the ocean, get pounds that way, and then use the pounds to go back into dollars and so forth. That strategy or that arbitrage opportunity was available to anybody. Anybody could take those currencies and present them to the relevant authorities and get the gold. During World War I, everybody except the U.S. just suspended it, and then afterward, they started slowly coming back in fits and starts, and there were a lot of problems. And I would argue that's partly what fueled the booms and crashes that set up the Great Depression. All right. In the Bretton Woods era, though, private citizens were still not allowed to own gold. In the United States, it's not simply that you couldn't own gold. You could have jewelry, but I'm saying you couldn't have like monetary gold. You couldn't hold gold as an investment, and certainly not as a hedge against a depreciating dollar. It was literally illegal. Not only couldn't you hold gold, you couldn't even write contracts that had gold clauses in them, right? So you couldn't sell a building to somebody and then say the buyer is going to pay me 10 annual payments for the purchase of this building that will be equal to the global price of gold times whatever, 100 each year for 10 years. Like, in other words, they're paying me in dollars, but how many dollars do they owe me? We're going to reference the gold price in dollars, the global price. That you couldn't even do that. All right. So like the courts wouldn't enforce such contracts. So they were really going out of their way in the Roosevelt administration to wean Americans off of gold and to get them to stop using it as the money, right? That, Americans use dollars, but it was always had been defined as a certain weight of gold. And ultimately, gold was like the backstop. And so they were really going out of their way to get Americans to stop thinking like that. Okay. But in the Bretton Woods era, what they ended up doing was, I've seen it called a gold exchange or a dollar exchange standard. The idea was what they were trying to do is get all the central banks of the world to not hold gold reserves, but to hold dollar reserves, right? So foreign central banks, instead of having vaults full of yellow metal, the idea was, no, just have a bunch of treasury securities. And those are as good as gold because you guys can turn them in. So that was the idea, that under the Bretton Woods system, the U.S. authorities said, we're pegging the dollar to gold at the rate of $35 an ounce, but that offer isn't available to Joe Schmo. It's only available to other central banks. Okay. And so what they said to them was, you can present, if you have dollar assets, you can present them to us and we will give you gold upon demand. And so that was supposed to make the other central banks comfortable releasing their gold reserves and just stockpiling dollar assets. Okay. And then the US government, though, was supposed to maintain that convertibility in order to keep everybody happy with that. That was the only thing that would make the system work. The Vietnam War, LBJ's so-called war on poverty, put pressure on that system. The authorities kept printing money, metaphorically, and the authorities would do things like whenever the market price of gold was popping above the 35, that was setting up arbitrage opportunities, right? That these foreign central banks that had stockpiles of treasuries, they could turn those in and get gold at the price of $35 an ounce and then go sell it at the market price, which it kept creeping higher and higher. So at some point, what are you going to do about that? And so the authorities, U.S. authorities, were doing all sorts of things behind closed doors to try to get these other central banks to not call in their chips. But eventually, like, there was a problem, like in the late 60s, famously, the French wanted to start calling in their gold. And famously, in 1971, Richard Nixon finally throws in the towel. At that point says, at the time he said it was a temporary measure. Well, it's been a pretty long temporary. Says, yep, we're throwing in the towel. Okay, so I'm explaining to you why is it that the U.S. government owns so much gold, and where did the 42 come from? It was in 1973. At that point, in other words, like the $35 an ounce was kind of out the window once they closed the Bretton Woods system, and then in 1973 they revalued the gold at $42.22 an ounce. All right, so. And then that's just how they've been carrying it at that book price since then. Okay. Incidentally, let me just mention, there are many people who don't think the U.S. government actually still holds all that gold. They think that over the years, as gold prices have crept higher and higher, because among other things, that could be construed as a critique of U.S. monetary policy, like a stark indication of how much they've inflated, to say, like, can you imagine? It used to be the case that an ounce of gold was $20.67. So they should give you some idea of how many dollars they've created in the interim over and above, because gold has been mined, right, since then too. Some people speculate that, maybe they're shorting the gold market with like borrowing out of these stockpiles and then using that to sell into the market to push the gold price down without letting that be known to people. So I don't know if that's true or not, but I'm just saying that's partly why there are calls to audit Fort Knox and, the gold that's ostensibly held at the New York Federal Reserve Bank. I think that was the backdrop to one of the Die Hard movies. Okay, so just to give you that history. So having said all that, now the idea is, okay, well, looking at the U.S. government's books, they've got this huge stockpile, allegedly, of gold. Oh, the other thing too is that note that I just read from, said in the footnotes. This was my understanding too, but it confirmed technically, I think the U.S. Treasury is the formal owner of that gold as opposed to the Fed. Okay, but for what I'm going to go through, I don't think that's a huge deal. But anyway, I just wanted to point that out. So the idea is, couldn't the government somehow recognize that capital gain market to market and do something with that money? Like, it seems like it's not cheating, right? Like, what they really do own the gold. It really is being valued on the books way below market value. So can't they do something with that? Okay, so let me just walk through some of the options. Okay, one option would be just to sell it, right? And you obviously would not sell it at $42 an ounce. You'd sell it at the market price. Okay, so you could do that, and if you sold all of it, you'd make a little more than $850 billion because you'd get the 40 as well. That 850 was just my ballpark of the gain, right? But you'd get the original book price too. Okay, so you could do that. And then, the US government would take in an extra whatever, 860 billion, and that wouldn't increase the deficit. You wouldn't need to increase taxes. You could do whatever you wanted with that. You could buy some Bitcoin to use to augment the strategic Bitcoin reserve. You could pay off some of the federal debt. You could reduce, what's the kind of the same thing as reducing the deficit this year. So not adding as much to the debt because of current spending and the mismatch between spending and tax receipts. All right, you could do that. Or you could use it as you could give a rebate to all the US taxpayers to just do a one-shot deal. Just take that total amount and divide it up. I could send every American adult a rebate gold check if you wanted to. Okay, all kinds of stuff you could do with it. The problem with that, though, is even though it's true, it wouldn't per se increase the deficit. It wouldn't be inflationary. But the problem is, once you did that, you wouldn't have the gold anymore. And a lot of people are hesitant to do that. Because among other reasons, even though formally that gold has not been backing up the US dollar since 1971, there are still a lot of people, including me, who, when we're throwing out ideas for reforming the US monetary system, like in my case, I'll say, ultimately, I want to just devolve everything to the market, let the market decide. But in the interim, I recognize that's kind of a radical step, and probably a much more palatable move would be to shut down the Federal Reserve and return the authority to issue new US dollars to the Treasury. I think that was something I've done recently on InFi. Actually, the one I'm thinking of was the Human Action podcast. I have talked about this stuff at InFi, but the specifics where I go through a realistic plan whereby you could get rid of the Federal Reserve just to show you'd still have dollars, right? The Federal Reserve was created in 1913. What money did Americans use in 1912? It was the US dollar. Okay, so you should never think that getting rid of the Fed would mean we wouldn't be able to use dollars anymore. Those are two separate things. Okay. I was making a note to link to that and the Fed discussion that I did on a different podcast. In case you're curious, put in the show notes page here. Okay. But my point is, back then, when I did that, my proposal was to say, okay, if we're going to return that power to the Treasury, what rules should they use, or what principles should they follow when deciding how to issue more dollars, if any? And I said, well, they could just make it going forward be backed 100% by gold, so that if they were going to issue new $100 bills, $50 bills, and so on, they would lock in the current market price of gold quoted in US dollars, and then further issuance of that what's called base money would be back to 100%, right? So it wouldn't immediately try to achieve 100% backing of all existing base money, because that would be problematic, but it would have it asymptotically approach 100% backing, because, again, all newly issued currency. And so if that's what you're going to do, it might make sense to keep the stockpile of gold we currently have and just use that as the starting point to kind of reassure the markets that when we say the dollar now is backed up by gold, again, at this new price, whatever, $3,500 an ounce or whatever, then, it's credible. Because look at how much gold we're starting out with. So it might be short-sighted to just sell off all the gold, given that we might down the road want to have this proposal to strengthen the dollar by relinking it. Okay. Another option would be to post the gold as collateral to outsiders and then have them lend to the US government. And so there we keep the gold, but we also get the funds. So the upside is you get to keep the gold. So that's what's different from the first scenario where they just sell it. Another upside is you capture that capital gain, right? When we post it as collateral and borrow against it, the lending entity assessing the collateral can recognize that, if we seize that in the event of a default on this loan, we could sell that, they would value it at the market price. So that's a benefit. And then the question is, would that increase the national debt? It would in gross terms, but not in net terms relative to the current position, right? So right now, we're not valuing that at the market price, that we got the outstanding Treasury debt. And then the idea is that the Treasury then posted that gold as collateral to some outside entity, and then an entity lent against it. If we're on the Treasury's asset side marking up the gold for that to recognize that capital gain while simultaneously incurring an external debt, it wouldn't be one for one because, the LTV they'd give you wouldn't be 100%, but you get the idea. So yes, the Treasury would owe some outside entity money, but it would have a solid asset backing that up. So it wouldn't be unsecured debt the way that just general treasuries kind of are. I mean, they're claims on tax receipts, I guess, if you want to look at it that way, but you get the idea. Okay, so you could do that. And now here's where things get interesting. So it's not a tax hike. You keep the gold. You arguably don't increase the net national debt through those accounting moves. Now the question is that inflationary? And here I think it matters who they borrow it from. So if you post it and just borrow from some regular company that's not a bank, it's not inflationary. That some other entity that just, they could be some rich hedge fund or something, but as long as it's not actually a bank, and the way our system works, it can't create money. And when I say that, if you don't know what I'm talking about, I'll link also in the show notes page to the recent series of blog posts I've done walking through this stuff, showing how is it that the first one is really the one you want that I'll link to, that it shows in what sense can commercial banks create money in a way that like Tesla can't. All right, and that's when you see that distinction. Okay, so in terms of, plain English, man on the street, if Tesla, for example, is lending to the U.S. government against these pledged gold holdings as collateral, Tesla needs to have the money first to be able to lend it. So that's just transferring money from one owner to another. That's not creating more money in the system. And so that's why it's not inflationary. Just like if, your buddy borrows $100 from you and says, I'll pay you back next month, the money supply didn't go up by $100. You have less to spend and your buddy has more. And then if he pays you back, it's vice versa. Right? So total spending doesn't go up. It just gets rearranged. Same thing. If Tesla comes up with $400 billion to lend to the government against its gold reserves, Tesla can't use that $400 billion for something else. That had to come from somewhere. And so there's no reason to expect total prices to go up because the total money supply didn't change. It just changed hands. Okay? In contrast, if the government posts it and a private commercial bank underwrites it and lends, then there arguably that does increase the money supply. So here, I'm not going to get into the mechanics. I point you to the blog post I did if you want to see me spell that out, if you don't understand what's the difference. And then what I think a lot of people had in mind is that the Treasury would not go to Bank of America to handle this. They would go to the Federal Reserve, the Treasury's banker, right? That's where the Treasury keeps its checking account, is with the Fed. The central bank is the bank of the central government. That's one of the functions that central banks typically perform. So the idea is if the Treasury is going to do this accounting move, and like I say, I've seen different versions of this. I think some people think that the Fed right now is the legal owner of the gold, which I don't believe is correct. But some people are saying, oh, the Fed's going to mark up the value of its assets. So it's like portfolio, the Fed's portfolio, which they think includes a bunch of gold. And then that capital gain then goes into the income earned this year. And then the Fed normally remits its earnings to the Treasury. In a typical year, if the Fed earns positive interest income on its bond portfolio, it pays, its electric bill, blah, 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 pays the salaries of all the economists working for the Fed, writing papers on how great the Fed is. And it pays dividends to the private banks that literally own the Fed, in case you didn't know that. That's the typical expense the Fed has, is to pay dividends to its shareholders, who are private banks that the Fed regulates. And then whatever's left over, it remits as excess earnings to the Treasury. All right, so that's another mechanism that I saw people saying could be used to mark this gold to market, have the Fed recognize the gain and pass it through the Treasury. And so there, I think people believed there would be no downside to that. They would just be recognizing reality, and then now the Treasury gets to spend that gain. And I don't think that's right. I think the step they're missing is that in order for that to happen, the Fed is creating more base money, right? For the Fed to mark that gain and then somehow come up with $850 billion to transfer into the Treasury's checking account, its reserve account with the Fed created that $850 billion that didn't exist yesterday. It's not taking it from somebody else. Nobody else is paying to get a piece of the gold. The Fed's not selling the gold, nor is it borrowing from outsiders and pledging it as collateral. No, in this version of the story, the Fed is somehow creating the $850 billion electronically and then just passing it through the Treasury. So I'm saying that is inflationary, even though it's, quote, backed up by a real asset. Still, other things equal, you create $850 billion and the Treasury spends it, that's going to raise prices compared to counterfactual where they didn't do that. Okay, so maybe you still think that's a good idea. I'm not saying it's a bad idea, but I'm saying I think people believed somehow that last category of operations not only wouldn't increase the debt, would still allow the government to own the gold, would fuel $850 billion of extra spending to do something with, maybe buy Bitcoin, but also it wouldn't be inflationary. And I think that last one is not correct. Again, if you wanted to be able to recognize the gain on the gold, spend the money, and not have it be inflationary, you would have to sell the gold off, or you could sell the gold off, because then the dollars you're getting just come from somebody else who had them, right? They're just, some people out there are sitting on some dollars, and they would be willing to transfer their dollars to the Treasury in exchange for its gold. Right? So their new dollars haven't been created, they've just been rearranged. The Treasury sells its gold, the other people, quote, sell their dollars. So that's not inflationary. But if the Fed is internally recognizing the gain and then passing through $850 billion, where'd that come from? The Fed just created it electronically and credited it to the Treasury. And so that's inflationary. Okay. All right. That's a good place to wrap up. Again, if you want to see follow-up discussion on all these points, I'll point you to the show notes page. Till next time, this has been Bob Murphy here at Infineo.